Goldman Sachs, the probably most influential investment bank in the world, just warned of a significant change in behavior on Wall Street, and they've put a report out on that. I've got the report in my hands, and I want to share it with you. I want to summarize it with you so you are the best informed investor out there and you know how to make money out of this. If you really want to learn how to make money, join me also tomorrow, Tuesday, 8 p.m. Eastern Time, for a live trading training where I will show you how I made over 100% return on capital employed in 2022 and in 2023, and we're doing pretty nicely this year. And it's for beginners. You don't need to know a thing. Just come and join me, felixfranz.org/training. But let's jump into what the Goldman's lot have got to say. So they're saying, number one, the trading floor is showing that after 5 weeks of buying, hedge funds have now turned around and they've actually sold US shares, not just last week, not just sold, but actually are selling at the fastest pace since January this year. And that's a significant event that we should bear in mind when we're looking to, YOLO into the market here. And I'll come back to what is actually the smart strategy right now in just a moment. But they were selling index and ETF trackers, basically. They were selling single stocks, so individual stocks. They've been doing that for three weeks, by the way. But the fact that they're selling the index is new. And it's the largest net selling so far this year. So it's the largest sales event from hedge funds so far this year. And they were selling not just some sectors, are not just going, oh, Nvidia may be too expensive or something. No, they're selling actually all 11 sectors, the whole freaking market. Industrials particularly is probably one that's notable because they've been selling that for like 2 weeks in a row now. So that's maybe something to think about. But if you look at number two then, US share sales are just a little bit different to hedge funds, right? It's just like the broader market. What do we have last week? Well, we had relatively hawkish Fed speak. We had a relatively cautious commentary from central bank, from banks generally, JP Morgan and so on. The Fed minutes were a little bit more hawkish. Some of the software earnings that came in were a little disappointing, and less volume. Just people, I don't know, go on holiday or something. Probably all the bankers are in, I don't know, Connecticut or something like that, and therefore, volumes dropped. But you did have outstanding results from Nvidia, and it went up like 15% or something crazy. So what does that mean? Well, there is still some positivity from the market overall in buying, particularly into tech and into healthcare, and also somewhat into energy, which is something that we've been highlighting for a couple of months now as a good opportunity, I think. I'm going to skip, I think, the futures because most of you probably are not futures traders. So I'm going to just like skip over number 3 here and go back to number 4, which is derivatives sales. What the heck does that mean? It's basically options. So like the kind of call options, put options, that kind of thing, which is something that I do. And they're basically saying right now, fear in the market, and this is really important to understand, and most people don't understand this. Maybe people are not even aware of this. Fear. The VIX index, VIX, is at the lowest level it's been 10 years, basically, pretty much the lowest level it's been in 10 years. And what does that mean? It means nobody is protecting their portfolio. No one's thinking there could be some risk event here. And everyone's just saying the sun's going to shine, the sky's going to be blue, and la-di-da-di-da. And is that an opportunity? Yeah, frick yes. Of course it's an opportunity. Why is it an opportunity? Because we can, if you understand options, you understand we actually make money out of volatility. That sounds abstract. But to make it a bit more concrete, options right now are the cheapest they've ever been in the last 10 years. So the smarter thing, say if you're bullish the market, would be, in my opinion, to buy a call option or maybe something slightly more complex and not buy the stock because your upside's greater, your risk is lower, and it's very likely that volatility will go up at some point and you will benefit from that. But for that, as I said, you need to understand this a little bit more. I'm not telling you to go out and buy a call option if you don't understand how the heck this works. Come and join me on Tuesday instead, felixfranz.org/training, and I'll make you into a competent trader there in about 90 minutes. Now, basically Goldman's are saying is, yeah, options are the cheapest they've ever been, and they're looking at how to set up trades for that, and they run through a couple of things, which I'm not going to bore you with because I think it gets a little bit too technical. Now, what about ETFs? That's something that's closer to home for most retail investors out there, index funds. So volumes, ETF just trading volumes hit a low for the year. We are seeing that particularly real estate and energy are seeing buyers. The energy trade I've highlighted a few times the last few weeks. Essentially, that's an AI piggybacking because AI needs so much freaking energy. And real estate is probably a sort of calling the dip moment, as saying it's so freaking bad out there that it can only get better. And that's a point of view if your time frame is long enough. And then if you look to number 6 here is like, what are the kind of themes? What is Wall Street giants trading right now? And they've just launched a new AI trade, and they call it the PC and mobile device AI upgrade trade. Catchy. I know they have an acronym for that as well. GSXUPC AI. Helpful, isn't it? I love how they make things simple on Wall Street. Essentially, what they're saying is that all of you bought new laptops, new phones, new computer gadgets during COVID because you're bored, you were at home, you had extra income, you weren't wasting it on commutes, you weren't wasting it on lunches out of the office and just generally, wasting it at Starbucks. So you had extra income, plus the government was giving you, little extra paychecks, which was very nice. And so you bought laptops because you were working from home, right? Yeah, right. Lying in that backyard, right, in the sunshine, going, I'm working, honest. So what are they saying? They're saying that the replacement cycle, this is how long ago COVID started, is back. And they're saying that they're seeing a big opportunity here that stocks like HPQ, right, Hewlett Packard, which right now is trading at only 9 times next year's earnings, which is relatively inexpensive. They're saying that the AI features, like what Microsoft just announced, right, saying our laptops will now be AI laptops and they'll be different to anything you've ever seen, that people will therefore want to replace their old COVID equipment and upgrade. And I think that basket's an interesting one. Do you want to know what it is? I'll put it on the screen for you here, okay? I'll put the whole list of stocks on the screen here for you that they're actually looking at. So they're looking at a real like PC recovery kind of trend. And let me put it on the screen here for you. So here, the composition. So we've got Dell, we've got Apple. I definitely agree with Apple. I think there are 250 million 2016 iPhones out there. And at some point, you're going to have to replace that stuff. It's just become silly. I'm not usually somebody who has the latest phone, although this I think is the latest phone because it has a slightly better camera. But most people don't because it just doesn't make any sense to spend $1,000 on a phone all the time. But when your phone is like 8 years old, it's going to fall apart. You know it, right? You've dropped it a fair few times. It's got the cracks and it's cutting you when you're using it and so on. Plus, there is now an excuse, which is AI. AI is there and it's going to make everything better. So I think that makes sense. They've also got HP and Hewlett Packard Enterprise, Western Digital, ARM, Qualcomm, TSMC, Intel, Micron, Broadcom, AMD, Skyworks, Seagate, and a bunch of others. So a little bit less relevant. So that's definitely one thing to look at. Some other sectors they're highlighting is TMT here, which is basically tech. So another monster week, obviously, for tech. We've had, over the last month, NVIDIA up 32%, Netflix up 17%, Apple up 13%, AVGO up 12%, and so on. So it's been a really, really good week. And I think really the NVIDIA beat, the acceleration in their data center revenue is good for everybody, for Google and for Amazon and for the whole back end of that. So I think that story is definitely still a very, very good one. If you look at consumers, that's you, then the data gets a little bit more mixed. So we have had earnings reports in from a lot of the consumer stocks last week, and they were a little bit like, yeah, not brilliant. Pretty much every consumer stock out there, but that's Target or Walmart or someone, is sort of warning that the consumer is just getting poorer. And I'll dive a little bit deeper into that as well on another video. We're doing some research at the moment. But yeah, there's definitely some concern there of a sort of consumer consumption recession. So I'd be a little bit cautious with consumer stocks. Healthcare, not a lot, I think, on the healthcare front. So what do you see happening like this in these kind of environments? Well, I think some bad news eventually always comes up, right? There's always something that kind of spooks the market a little bit. So I think there is a very, very clear trade for owning some volatility. And maybe you don't know how to do that. As I say, come and join me tomorrow, felixfriends.org/webinar. I'll explain it to you. And secondly, there will, in those events, be a flight for safety. Traditionally, that flight for safety is, of course, into US treasuries, but you don't necessarily need to go that far. The first flight to safety is always into the companies with the strongest earnings. So that'll be your Apple, your Microsoft, your Netflixes, your Amazons, possibly your Nvidias. Although I think Nvidia people are still a little bit antsy about, despite their insane delivery. So I think actually a big tech basket right now is probably one of the best places one can be, and that'll probably do pretty well throughout 2024. Of course, I haven't got a crystal ball, nobody does, just sharing a little bit of my background here. And I think overall, understanding how to protect your portfolio, understanding the stuff that Goldman Sachs is talking about here, like volatility and VIX, it just sounds like, I don't want to, it sounds like calculus or something. Why are you torturing me with this, Felix? It's not that difficult. It's can be explained to you in an hour or a couple of hours, and you'll understand it, and you look at the market in a different way than you ever have before. And to me, that's what this community is all about. It's just like getting everyone to the next level of knowledge and having fun with it, and getting to freedom and being able to do what you want to do, whether that's travel or buying that home or looking after your parents or whatever it might be for you, and actually getting there through your money working for you rather than you just working yourself to the bone. So come and join me tomorrow, felixfriends.org/training, and I'll walk you through exactly what I do and how I do it. Thanks for tuning in.
Something has just happened that we haven't seen in financial markets since the global financial crisis in 2008. And you might be thinking, oh no, this is another doom and gloom video. It really isn't. I want you to understand what's happening out there, what the risk is, and show you how you can make